Have you ever wondered how a bank can afford massive skyscrapers, thousands of employees, fancy mobile apps, and still offer you free checking accounts? After all, when you deposit money into a bank, they're holding your money, not selling products like a normal business. So where does all the profit come from? The answer is surprisingly simple, and also a lot more complicated than most people realize. Banks aren't just giant vaults storing cash. They're businesses designed to make money from money itself. Today, we're pulling back the curtain on how banks actually make money, where their biggest profits come from, and why your savings account may be helping them earn far more than they're paying you. Let's get into it. At its most basic level, a bank does one thing. It takes money from people who want to save it and lends that money to people who want to borrow it. Imagine you deposit $1,000 into a savings account. The bank doesn't lock that money in a box with your name on it. Instead, it combines your money with deposits from thousands or millions of other customers and uses much of it to make loans. Those loans could be mortgages, car loans, business loans, personal loans, or credit card debt. And here's the key. The bank charges borrowers a higher interest rate than it pays to savers. This difference is called the net interest margin, and it's one of the biggest sources of bank revenue. For example, if a bank pays you 2% interest on your savings account, but charges someone else 7% on a loan, the spread between those rates contributes to the bank's profits. Multiply that across billions of dollars in loans, and the numbers become enormous. If lending is the engine of banking, credit cards are often the turbocharger. Credit card interest rates can be extremely high compared to mortgages or traditional loans. Many cardholders pay off their balances every month and avoid interest entirely. But millions of others carry balances from month to month. When that happens, banks collect interest payments that can add up quickly. On top of that, banks often receive interchange fees. Every time you swipe your card, the merchant pays a small fee to process the transaction. A portion of that fee goes to the bank that issued your card. That means banks can earn money whether you carry a balance or not. The more people use their cards, the more opportunities banks have to generate revenue. Interest isn't the only way banks make money. Fees are another major source of income. Some common examples include monthly account maintenance fees, overdraft fees, wire transfer fees, ATM fees, foreign transaction fees, late payment fees, account service charges. While an individual fee might seem small, banks serve millions of customers. A few dollars collected from millions of accounts can generate substantial revenue. Over the years, some banks have reduced certain fees due to competition and regulation, but fees still remain an important part of the business model. When someone buys a home, they often borrow hundreds of thousands of dollars. That creates a significant opportunity for banks. Mortgage loans generate interest income over many years, sometimes decades. But banks don't always keep these loans. In many cases, they bundle mortgages together and sell them to investors. This allows banks to recover their money quickly and issue even more loans. Banks can earn fees for originating the mortgage while reducing some of the risk associated with holding it long-term. In other words, they can profit from creating the loan without necessarily keeping it on their books forever. Consumers aren't the only customers banks care about. Businesses are often even more valuable. Companies need checking accounts, payroll services, loans, credit lines, payment processing, and cash management systems. Banks charge fees for many of these services. Large corporations may also use banks for financing major projects, issuing bonds, managing investments, and handling international transactions. These services can generate significant revenue and often involve much larger sums of money than typical consumer banking. Some of the world's largest banks do much more than accept deposits and make loans. They also operate investment banking divisions. Investment bankers help companies raise money by issuing stocks or bonds. They advise on mergers and acquisitions. They assist corporations with complex financial transactions. For these services, banks can earn substantial fees. When a company goes public or acquires another business, the advisory fees alone can reach millions of dollars. This is one reason why some global banks report enormous profits even when traditional lending isn't performing exceptionally well. Banks also invest in financial assets. These can include government bonds, corporate bonds, and other securities. By carefully managing these investments, banks generate additional income. However, this activity comes with risk. If investments lose value or borrowers fail to repay loans, banks can suffer losses. That's why banking is heavily regulated. Governments want to reduce the chances of a bank taking excessive risks with customer deposits. Here's a fact that surprises many people. Banks don't keep enough cash on hand to repay every customer simultaneously. And that's because under normal circumstances, they don't need to. Most customers leave their money in the bank. Some people deposit money while others withdraw it. The system works because not everyone asked for all their money at the same time. If everyone did rush to withdraw their funds, it could create what's known as a bank run. Historically, bank runs have caused major financial problems, which is one reason governments created deposit insurance systems and banking regulations. These measures help maintain confidence in the financial system. Modern banks have expanded far beyond traditional branches. Today, they earn money through online banking services, digital payments, wealth management platforms, and partnerships with financial technology companies. Some banks even generate revenue from subscription-style financial products and premium account services. Technology has changed how banks operate, but the fundamental goal remains the same. Find ways to earn more from money than it costs to acquire and manage that money. So how do banks actually make money? The biggest source is lending money at higher interest rates than they pay on deposits. But that's only part of the story. Banks also earn money from credit cards, fees, mortgages, business services, investment banking, and financial investments. At their core, banks act as financial middlemen, connecting people who have money with people who need money. And by sitting in the middle of those transactions, they create one of the most profitable industries in the world. The next time you check your bank account, remember, your money isn't just sitting there. Behind the scenes, it's part of a massive financial machine that helps banks generate billions of dollars every year. If you enjoyed this video, don't forget to like, subscribe, and turn on notifications for more deep dives into how money, business, and the economy really work. Thanks for watching, and we'll see you in the next video.